Hey guys, welcome back to Mitchell Markets. Today we are going over smart money, okay? We are going over vertical spreads, a thing that a lot of people find complicated or confusing, but we're going to dumb it down a little bit, make it easy for you to understand, and explain why vertical spreads can be so powerful in neutral markets or slightly bullish markets. It's a great way to hedge against downside and still have reward on the upside. We are currently looking at company JD.com. It's a Chinese e-commerce company, very good, similar to Amazon or Alibaba. Alibaba has been doing fantastic recently, was one of my picks. So we're not going to be going over JD too much today, other than the fact that it is in my personal buy zone. But this video is currently about spreads, how to execute spreads. We're on Interactive Brokers, not Trader Workstation currently, just the Interactive Brokers website, and we are going to go through some options and pick out a good spread. I already have plenty of calls and shares on JD, so I'm not looking to add any more risk, but I do want to still gain some additional reward on Interactive Brokers, but also mitigating any downside in case the trade either falls flat or, worst case, underperforms in general. So with JD, we are going to be looking at a vertical spread profiting above this 34 range, which is a bit in line of key metrics and support. So if we do fall below that, luckily our risk is capped off with these spreads. But if we do not, the key thing about the spreads is you do not have to have a drastic rise in share price to collect full profit. So essentially we're going to be going over call spread. So essentially with a call spread, you're buying a call at a lower strike, you sell a call at a higher strike, and you use this when you expect the stock to go up moderately or hedge against downside risk. And there is limited risk, the premium paid, but there is still limited reward. The reward is capped, but the reward is a lot less of a stretch. You don't need a big move like call options or just holding the underlying. So we're going to go click over to the options, and I already have it clicked on vertical spreads. So you'll see here we have calls and puts, calendar spreads, vertical spreads, diagonal spreads. We are going to want this vertical spreads here, and I am looking once it loads back in. I am probably going to be looking around a 34.5, 35. So just a 50-cent change here, which is moderate, I would say, for a company this size. So let's check out these 34, 5, and 35. So as you can see, I'm buying the 34.5 and I'm selling the 35 call. Break even. In the range I'm looking for, I would prefer a little closer to the 34 range, but this is a decent range for me. 34.84 is my break even. My max return. You see, the max return is only $16. You're going to have to fill up a bit on these spreads to make it worthwhile, but especially in a sideways market, making anything is better than making nothing. Especially when you're looking compared to call and put options where you're going to be losing all of the premium. So a vertical spread is essentially anything below this 34.80, we'll call it, is going to slowly decline, and there's a max loss of 36. Anything above, slowly increase with a max profit. The nice thing is you can hit max profit quickly, whereas a call, unless you're deep in the money, you're also going to be taking a while to start seeing good gains on your risk. That's the thing, how much you're risking versus the potential reward. I'm only risking 36 for reward of about 14, but I'm already below the current stock price. So I'm well, I'm very bullish on JD, but this would indicate a moderately bullish sentiment. But like I said, I'm just using this to hedge against current positions on option contracts, just in case premium takes longer and I start losing some of that. This is going to reap some of those rewards back to me. And just as an example, we'll show a few other spreads. And this is my smart money step one, essentially, is spreads. I've been doing spreads on UNH for a long time. It just saves you from losing out on all of the premium decay, theta decay, as well as profiting if it doesn't move exactly how you time it. And that's the difficult thing with options trading, is timing. And something to keep in mind, the closer to the share price or above the share price you're at, the less you're going to be risking based on how much you're going to be profiting. So if we look at a higher position, we're going to be risking about 58 for a 41.99 profit, and that's just because your odds of collecting the full amount are slightly less. But this still is not a bad entry point. As we look here for the break even, 35.03. I'm still wanting to stay in the 34 range. We'll check out a 34 34, maybe 40, too high, 34, 30, yes, here we go. Okay, so we'll check out a slightly lower one here, 34, 35, slightly lower, slightly more return, but that's just because the stock price has decreased just a little bit. Let's see if it holds this 35 range. Can hop back over to quote, check it out, see where we're moving at. The 1 day, 35.01. We'll check out the 1 week. Might retrace back to the 200 EMA before we get a bounce back up, but this is where the spread's going to be key here. Alright, let's place our position. I'm still thinking that the 34.5, 35 is what I'm looking for. Yeah, the max losses just increases here. 4 and 6, 35 and 15, 34.92, 58. This is the range I'm looking for in these 34s, but let's see where the share price is currently. Okay, so what we're going to do here, we're going to order a few of these spreads. Limit price, what does it ask here? Ask 54, bid 47. We're going to try to find a middle ground, maybe 0.52. See if we can get filled. Do not want to attach a stop loss or a profit taker. I'll just watch and see where we're headed. Okay, perfect. We got filled in between, and now let's add a couple lower ones. Calculator, check the in between. $18.32. I'm really for risk reward purposes, I'm really liking this 35.01. Might just add more onto here. Go for a nice 600 would make it more ideal for me. So I think what we'll do, we'll add more of this 34.5, 35.5. Risk reward is a bit better. I don't see breaking below 34. Add on to here. Again, we're going to want to go in the in-between. 0.54. Three. Okay, we are filled here. And that's about it, guys. May even add an additional position at some point. So to sum it up, guys, vertical spreads are very good for hedging for a sideways market, slightly bullish market. Collect that premium, get some good risk reward with limited downside. Yes, there's limited upside, but at least you're still making money.